Good day, everyone. I hope all of you had a wonderful Labor Day weekend and got some rest and a chance to get away from the markets. I had a very volatile weekend myself. My wife had our third child 3 weeks early, and we were in the mountains for the weekend. So it was an adventure, to say the least. But fortunately, everything went well, and I'm a proud father of my third child. Getting back to the markets, the big story is again Syria. But this time, instead of an imminent strike we were expecting last week, our president requested congressional authorization for a limited military strike, so we're not out of the woods just yet. But a congressional authorization can take some time, so it takes the urgency out of the situation. But keep something in mind. Congressional authorization for these type of actions have never been denied. So I doubt this decision is going to prevent the strike, but it does take the immediacy out of the equation. Note that Congress does not come back from vacation for another 6 days, so the chance of having an imminent missile strike is out of the window for now. But the pressure from Syria is far from over, and the markets are not going to be immune from this pressure for the next few days. In addition to the Syria situation, the stock market got a little lift this morning from the Institute of Supply Management, which stated that its manufacturing index rose to 55.7 in August from 55.4 in July. That topped the index's 12-month average of 52. Any reading above 50 indicates growth. This is the fastest pace since June of 2011 and signals that manufacturing output could strengthen in coming months substantially. The upbeat data reinforced the view that the Federal Reserve could in fact start to unwind its stimuli program at its upcoming policy meeting scheduled for September 17th and 18th. The strong manufacturing report had positive impact on the US dollar. For those who recently started following my analysis, the strong manufacturing report is another strong argument in favor of the Fed's cutting the stimuli program. And the less help US gets from the federal government, the more strength you will see in the US dollar. Investors and fund managers do not like to put large amounts of capital in countries that need support from their government, and the strong manufacturing numbers provide even further evidence that economy is in fact picking up. Therefore, there is higher likelihood that the Feds will slow down sooner, and this is the reason for the rally. So what's next for the dollar? Technically, we made a 1-month high today and backed away at 82.50, which is the resistance level that was created exactly 1 month ago. Statistically, the odds of breaking out substantially above a 1-month high or 20 trading days high are not a bet you want to take. It's actually below 40%. So statistically, there's a good chance we will back away from these levels before we continue going higher. Further, Syria is still not a resolved issue, and probably the fastest way to devaluate a currency is by going to war. We have to be mindful of that right now and not get too excited about the dollar. On the bullish hand, we have the Feds cutting the stimuli and creating a tighter economic policy. On the other hand, Congress will approve Obama's plan to attack Syria, and we don't know how that will pan out. I believe we will have a pullback from these levels before moving higher, and I think waiting before buying the dollar is in your best interest right now. The gold market came back to life today after 3 sell-off days, starting with an island reversal, which is a very common signal before the market changes direction. 2 things are causing the rally. First, we have the continued Syria situation, which if continues to escalate will cause the public to take money out of the stock market and put it into cash and gold. And second, we have the South African gold miners' strike, which could potentially create a short-term shortage, and that will also create a higher demand or higher gold prices. Right now, I'm watching the 1433 level. And if we do take out the short-term high, the next level up is the 1450 to 1480 level. There's a lot of resistance there, and we would really have to see some long-term damage to the economy to rally and maintain these levels. However, with war, there's never any guarantees, and both gold and oil prices are very dependent on Syria right now. If you recall, I've been very obsessed about the Japanese yen and the lower trend line I've been watching for a break for the last few months. The reason I'm so paranoid about the lower trend line is because the yen is very vulnerable to the downside from a long-term perspective. However, the market has been doing a pretty good job till last week and building a solid support area. Last week I alerted you to a possible break to the downside and warned you that if we do break, the next level will be par or 100. And it looks to be that unless the US dollar slows down its upside momentum, the yen will be sitting at par level within the next few sessions. My advice is to keep an eye on the US dollar for the next few sessions because it's going to make a big factor in how the foreign currencies perform at least till the end of this week. While I usually perform my stock market analysis in the beginning of the tutorial, I wanted to start with the other markets because so much of what's going on in the stock market is impacted by world events. The US stock market opened broadly higher this morning, mostly based on the fact that manufacturing is strongly improving and the attack on Syria is not imminent. Technically, while the market opened higher and made a higher high, which is a bullish indication, we are still trading below the 50-day moving average, and the broad market is still weaker than the tech sector. Opening higher and selling off is a sign of weakness. Until the broad market gets above the 50-day moving average, I'm not seeing much strength there. What I am concerned with is breaking the short-term low, which did not happen yet. If you recall, last week we had some leading subsectors break the low, and this alerted me to a potential strong sell-off in the broad market, and we did not see it yet. But remember, we are still bouncing off the short-term lows that we saw late last week, so unless we rally to a higher level and stay there, it looks like we're right where we were end of late last week. My suggestion is to watch the broad market right now, especially the 1630 to the 1627 area. You can see that we have a reasonable short-term support around this area. If you recall, late last week I showed you the Russell, which is the small cap index and tends to lead the market up and down. And last week we took out the low, and today we did it again. Remember, these are speculative stocks that are held by the general public more so than the large funds. And it's showing us exactly what the public is thinking right now. We broke the low on Friday, and today we broke it again. This is not making me feel warm and fuzzy about the state of the US market by any means. Let's take a look at a few setups for tomorrow's trading day. First, there's a 4x4 on GLD, which is the ETF that tracks the gold market. While it's a valid setup and you may want to take it, I suggest you keep in mind that your profit potential may be very limited if Syria doesn't pan out. However, if Obama does attack, and I doubt it will happen in the beginning of next week, we may see higher prices on this ETF, as well as the crude oil market. Place a buy stop 10 cents above today's high price, and if filled, place a sell stop 15 cents below today's low. The next setup is a tail gap to the downside. We are starting to see them more and more with the market trading below the 50-day moving average. The ticker symbol is ISIS, and what you need to do is place a sell stop 10 cents below today's low, and if filled, place a buy stop 15 cents above today's high. Remember to cancel both orders if no fill by lunchtime New York time. That's it for today's tutorial. I will update you tomorrow midday as usual. Have a great night, everyone.